Hello, welcome to KYC Bytes. Good morning, good afternoon, or good evening, depending on whichever time zone you're tuning in from. Before I start a topic, you should know that KYC is not an easy process. However, it becomes easier if you understand that any entity being onboarded or renewed in banks requires proper knowledge of how the business works. If you understand the business model, it will be much easier for you to understand KYC. Okay then, let's start. Today's topic is Special Purpose Vehicle, or SPV. Well, Special Purpose Vehicle has two words in it: special purpose and vehicle. The word special purpose means that the entity, the SPV, is created with a narrow, specific, and well-defined objective. It is not a general company that engages in multiple lines of business. Instead, it exists only to carry out one particular task, project, or transaction. Secondly, the vehicle. In finance, a vehicle refers to a legal entity or an arrangement that is used to carry or hold assets, risks, and investments on behalf of its owners. For example, a real estate developer may set up an SPV only to build one apartment complex. Once the project is completed and sold, the SPV may be wound up. So, combining both, a special purpose vehicle is a separate legal entity created by a parent company for a specific, narrow objective. It is designed to isolate financial and legal risk, meaning if the SPV faces a loss, the parent company's other assets remain protected. Before we go ahead, we need to understand what assets mean here. A simple definition of an asset is something we own. For example, we own our apartment, so the apartment is our asset. Similarly, banks own the loans they have given to customers, hence, loans are assets for them. Likewise, for governments or private companies, the roads, dams, and bridges, or any other infrastructure they build, are considered their assets. Going ahead, SPVs are called bankruptcy remote vehicles because they are created as separate legal entities. This separation means that if the parent or sponsor company goes bankrupt, the creditors of the parent cannot automatically reach into the SPV and claim its assets. The reverse is also true. If the SPV itself fails, the creditors of the SPV cannot pursue the assets of the parent company. Each one is ring-fenced from the other. This structure is what makes SPVs so valuable. By isolating risks in this way, they protect both the parent company and the investors, ensuring that financial problems in one entity do not spill over into the other. So far in this journey, we have understood that a special purpose vehicle, SPV, is essentially a vehicle that carries certain types of assets. Let's now get into the details. First, the SPV may carry lands, buildings, or apartments on behalf of a sponsor. The sponsor chooses to separate this asset from its main business so that its other ventures are not affected. By doing so, if the SPV suffers a loss, the exposure is confined within the SPV itself. This ensures that the sponsor's other businesses, projects, or assets remain insulated and protected from any financial or legal risks tied to the SPV. Second, an SPV may carry infrastructure assets such as toll roads, bridges, or power plants for a sponsor. These projects are usually large in scale and involve significant financing, long timelines, and complex risks. By housing them in an SPV, the sponsor ensures that the risks and liabilities of the project remain confined within the SPV. If the infrastructure project faces delays, cost overruns, or revenue shortfalls, the loss is absorbed by the SPV alone. This way, the sponsor's other businesses and assets remain unaffected, while investors and lenders also gain clarity that their exposure is linked only to the specific infrastructure project. Third, an SPV may carry intellectual property such as patents, trademarks, or copyrights for a sponsor. These intangible assets often generate revenues through licensing, royalties, or brand usage rights. By transferring them into an SPV, the sponsor isolates the ownership and cash flows of these intellectual properties from its main business. This structure allows investors or lenders to clearly see the value and income tied only to the intellectual property assets, without exposure to the sponsor's other operations. If the SPV faces challenges, such as declining royalty income or legal disputes over the intellectual property, the loss remains confined to the SPV. The sponsor's broader businesses and assets stay insulated from these risks. We will pause here for now. The other examples shown on this screen follow a similar pattern. Going ahead, let's understand who creates an SPV. Well, an SPV is typically created by a sponsoring entity. A company, financial institution, government body, or even a consortium can be a sponsor entity. The creator of the SPV is usually called the sponsor or originator. When the sponsor entity is worried about the riskiness of a project or a particular task, it considers the potential uncertainties, such as market demand, regulatory approvals, funding availability, or technological challenges. If the project fails, the losses could directly impact the parent company's overall balance sheet and reputation. Hence, the sponsor entity creates an SPV to separate that project or task from its core business. By doing so, any risk, liability, or financial loss is contained within the SPV, while the parent company and its other ventures remain shielded. This structure not only protects the parent, but also gives confidence to investors and lenders. Going ahead, as we learned earlier, the core purpose of an SPV is to separate a specific activity, asset, or risk from the parent company. Let's see examples of such purposes. 1. A US-based hedge fund may use a Cayman-based SPV to pool offshore investors. This makes it easier to attract international capital while maintaining regulatory and tax efficiency. The hedge fund's main operations remain separate, and investors know their exposure is limited to the Cayman SPV. 2. A property developer may create an SPV to build a new luxury apartment complex. The SPV owns the land, manages the construction contracts, and handles sales. The developer's other real estate ventures remain safe, even if this new complex is held up or fails. Going ahead, let's understand why a bank may need to create an SPV. Remember, banks are also in business, and just like any business, they face certain limitations. Take this example. A bank has issued a huge number of loans to its customers. Now, because of this large loan portfolio, the bank reaches a point where it cannot easily raise fresh capital or issue new loans. Why? Because regulators impose limits on how much a bank can lend. So what does the bank do? To free up space on its balance sheet, it creates an SPV. The bank sells a portion of its loan portfolio to this SPV. The SPV, in turn, bundles those loans and converts them into securities, often bonds, which are then sold to investors. Here's the interesting part. The repayments and interest made by the bank's original borrowers now flow into the SPV. These cash flows are passed on to the investors, who receive them as returns on the bonds. This entire process is known as securitization. In simple terms, the bank gets liquidity, the investors get a steady stream of income, and the risk of those loans is isolated within the SPV. Going ahead, let's talk about the legal structure of an SPV. Now, here's the first thing to remember. An SPV is not a one-size-fits-all structure. Its legal form can change depending on the country where it's created, the purpose it's serving, and what the sponsor really wants to achieve. At its heart, though, an SPV is always a separate legal entity. That means it has its own rights, obligations, and governance framework, completely distinct from the parent company or sponsor. Think of it as a legally independent mini-company created to carry out a specific task. So, what do these structures look like in practice? Let's go through a few common ones. 1. Limited partnership or limited liability partnership. This is widely used in private equity, venture capital, and investment funds. Here, investors come in as limited partners. Their liability is capped. They can only lose what they put in. On the other hand, the general partner takes care of day-to-day operations. 2. Trust. This form is very common in securitization and structured finance deals. In a trust, assets are held by a trustee for the benefit of investors. The big advantage? Bankruptcy remoteness. Even if the sponsoring company goes bankrupt, the assets in the trust remain safe and dedicated to the investors. 3. Government or statutory entity. In public-private partnership projects, SPVs can also be registered under special government regulations. For example, when building toll roads, airports, or power plants, governments often encourage companies to set up SPVs that are legally recognized under a statutory framework. 4. Limited liability company. One of the most flexible and widely used structures, especially in the U.S. In an LLC, the SPV is incorporated as a company with its own legal personality. The owners, or members, enjoy limited liability, meaning their personal assets are protected if the SPV faces losses. LLCs are popular because they combine the flexibility of a partnership with the protection of a corporation. For example, many banks and corporates use LLC-based SPVs to house structured finance products or real estate projects. 5. Joint venture company. Sometimes, 2 or more sponsors come together to pursue a specific project, say, building a power plant or developing a large real estate complex. Instead of working through one parent, they create a joint venture SPV. Each party contributes capital, resources, or expertise, and their ownership shares are defined in the SPV. This way, risks and rewards are shared proportionally, and the project remains ring-fenced. Now that we've understood the structure of an SPV, let's talk about the key players involved. Remember, an SPV doesn't operate in isolation. It connects many parties, each with a specific role to play. 1. Sponsor or originator. This is the entity that actually creates the SPV. It could be a bank setting up a securitization vehicle, a government establishing a PPP project company, a corporate launching a joint venture, or a developer isolating a real estate project. 2. SPV entity. The SPV itself, a separate legal company or trust, which formally holds the assets, liabilities, and obligations. Think of it as the legal container that everything flows through. 3. Investors or shareholders. These are the ones who put money into the SPV. They may provide equity or they may buy securities, like bonds, issued by the SPV, in exchange for expected returns. 4. Lenders or creditors. Sometimes SPVs raise debt instead of equity. Here, banks, bondholders, or financial institutions provide loans to the SPV. 5. Trustee. In structures like securitization, a trustee holds the assets on behalf of investors, ensuring transparency and protecting their rights. 6. Servicer or operator. This is the party that manages the day-to-day operations of the underlying assets. For example, in a loan securitization, the servicer collects payments from borrowers and passes them to the SPV. In infrastructure projects, the operator might run the toll road or power plant. 7. Regulators or authorities. SPVs are monitored by regulators such as central banks, securities regulators, or PPP authorities, depending on the jurisdiction. They ensure compliance, governance, and disclosure requirements. 8. Rating agencies usually play a role in finance-focused SPVs. If the SPV issues securities, rating agencies assess their creditworthiness so investors can judge the level of risk. 9. Advisors. Specialists who design the SPV structure and ensure it complies with legal, tax, and accounting frameworks. 10. End beneficiaries or customers. Finally, the ultimate payers or users whose cash flows sustain the SPV. These could be borrowers repaying loans, toll road users paying fees, home buyers paying mortgages, or electricity buyers paying utility bills. Moving further, when banks onboard an SPV, documentation becomes very important. Regulators and compliance teams need to clearly see who the SPV is, how it is structured, and who really controls it. Let's look at some of the key documents that are usually required. 1. Incorporation and legal documents. These prove that the SPV legally exists and is properly registered. For example, 1. Certificate of incorporation or registration of the SPV. 2. Memorandum and articles of association or similar charter documents. 3. Partnership agreement or trust deed if the SPV is set up as an LLP or trust. 4. Board resolution authorizing the opening of a bank account or entering into a transaction. 5. Proof of registered office address, such as a utility bill, lease agreement, or property tax receipt. 2. Ownership and beneficial ownership documents. These establish who owns the SPV and who ultimately benefits from it. Banks pay special attention here because this links directly to AML or CFT compliance. Examples include shareholding pattern or register of members, list of ultimate beneficial owners with their percentage holdings, identity documents of UBOs such as passport, national ID, or driving license, proof of address of UBOs, a declaration of beneficial ownership, in line with AML CFT regulations. 3. Director or authorized signatory documents. Banks must always verify who is responsible for running the SPV and who has the authority to act on its behalf. For this, the following documents are collected: a complete list of directors, trustees, or partners with their designations. Collect passport, national ID, and residence proof for KYC of each director. Collect passport, national ID, and residence proof for KYC of each authorized signatory, since they will operate the bank accounts. A board resolution or power of attorney authorizing the signatories to act on behalf of the SPV. 4. Regulatory and compliance documents. SPVs often operate in regulated environments, which means compliance papers are essential. Some key ones are tax identification number or equivalent proof such as PAN or EIN, depending on the country, global intermediary identification number if reporting is required under FATCA or CRS regulatory licenses, if the SPV is set up in sectors like insurance, mutual funds, or non-banking financial services, a legal entity identifier when the SPV is involved in cross-border transactions or trading activities. 5. Financial documents. For an SPV to be onboarded, banks also look at its financial standing and funding details. Depending on whether the SPV is new or already operational, the following documents may be collected: audited financial statements, where available, especially for existing SPVs; latest management accounts if the SPV is already operational and generating activity; funding documents that show capital contributions, investor commitments, or agreements that prove how the SPV is financed. 6. Additional documents required as per risk-based approach. Beyond the basics, banks also follow a risk-based approach. This means more documents may be required when the SPV is complex, high value, or linked to sensitive sectors. Common examples are a group structure chart, clearly showing how the SPV connects to the sponsor or parent company. Project or asset details that explain what the SPV is holding and why it was created. Source of funds and source of wealth declarations from the investors behind the SPV. Enhanced due diligence documents if the SPV is linked to high-risk jurisdictions or involves politically exposed persons, PEPs. Going ahead, let's understand when enhanced due diligence (EDD) is required for SPVs. Not every SPV will fall into this category, but whenever higher risks are identified, banks need to dig deeper. Some of the common situations are: 1. Complex ownership structures. EDD becomes necessary when the SPV has multiple layers of shareholding spread across different countries. The risk is even higher if nominee shareholders or opaque trust arrangements are involved. In such cases, it can be very difficult to clearly identify the ultimate beneficial owners, and that is where enhanced scrutiny is required. 2. High-risk jurisdictions. If an SPV is incorporated in an offshore financial center or a tax haven, such as the Cayman Islands, British Virgin Islands, Mauritius, or Panama, it immediately triggers the need for EDD. The same applies if the SPV is set up in a country that has weak AML controls or is listed by the FATF as high risk or under increased monitoring. 3. Politically exposed persons (PEPs) involvement. Another situation where EDD becomes mandatory is when politically exposed persons are involved. If the SPV's beneficial owners, directors, or authorized signatories are current or former politicians, senior public officials, judges, or military officials, the risk level goes up. The same is true when the SPV is linked to close associates or family members of PEPs. 4. High-risk sectors. EDD is also required when an SPV operates in sectors that are naturally vulnerable to financial crime. For example, SPVs linked to the arms trade, extractive industries like mining, casinos, virtual assets, or trading in high-value commodities. Sectors such as shipping or oil and gas are also closely monitored, since they have historically been used for terrorist financing or sanctions evasion. 5. Large or unusual transactions. If an SPV is created for an unusually high-value project or deal without a clear business rationale, banks are expected to investigate further. The same applies when an SPV engages in frequent cross-border transfers with very little economic substance. These patterns are often red flags for layering or other money laundering techniques. 6. Negative media or adverse information. Finally, adverse information in the public domain is a key trigger for EDD. If the SPV, its parent entity, or its beneficial owners are linked to fraud, corruption, money laundering, or sanctions violations in reliable media reports or public records, enhanced checks must be performed. Negative media often gives the first clue to reputational or regulatory risks. That's all for today. Hope you had a great learning today. Thank you. We will meet in another topic shortly.